Preston Reeves Wealth Management Seminar here at South Lodge. It's great to see so many of you here today when you could be outside enjoying the glorious weather. It's really nice to be able to run these seminars again and see people in person. We ran a few of these over the internet during lockdown, which didn't quite work the same. It's really nice to see people and catch up with some familiar faces. For those of you who don't know me, my name's Daniel Grainge and I'm Head of Tax at Preston Reeves. So we've got a great panel of speakers today. Kicking off proceedings is Rupert Tuvey from Tuvey's Antique and Fine Art Auctioneers. And Rupert's going to talk about all those things that may be hiding in plain sight on your walls or perhaps hidden in the back of cupboards that might have a surprising value. Rupert's incredibly knowledgeable and always very entertaining. I'd like to congratulate Rupert on his recent appointment as a Deputy Lieutenant for West Sussex. Very well deserved. And many congratulations, Rupert. As I say, the chattels that Rupert's going to talk about could be a significant asset within your estate, and so be important when we're thinking about inheritance tax planning that we're going to talk about later. Next, we have Lee Hayward from Preston Reeves Financial Planning, who's going to talk about retirement planning and ways in which income can be structured for retirement. Lee's a bit of a super sub today and is standing in at short notice for Kim Williams, who unfortunately has COVID. Next, Gemma Spencer from Preston Reeves Private Client is going to talk about wills, powers of attorneys and trusts and how these can be used to manage the future. And finally, Joe White is going to talk to us about inheritance tax planning opportunities. There's going to be a question and answer session at the end, and we'd ask that you save your questions until that session, when we'll also be joined by Gary Hicks, who's a partner and head of our Trust and Estates team, in case you ask any tricky questions about trusts. If we don't have time to answer all of your questions at the end, there will be members of our financial planning, legal and tax teams available over drinks at the end of the seminar, and I think most of them are lurking in the back row, so can help you. All three of the Preston Reeves presentations will be linked by a case study to try and bring the subject to life and see how some of the planning opportunities that are available would affect a client and their family. After Rupert's spoken, I'll come back and set the scene for that case study. We recognise that case study won't reflect everyone's circumstances and the values involved are quite high, but it's really used to illustrate some of the planning ideas and opportunities that might be available to you. In the time we have available, it's not possible to cover all the different options and possible ways that your inheritance tax exposure could be managed, but it's really to give you an idea and some examples of what is possible. So please do remember there are lots of other ideas and strategies that might be suitable in your situation. I think a really important thing to remember is that if you're undertaking any planning, it's vital that it's tailored to your personal circumstances and to what you're looking to achieve. It's not about finding a product and putting that in place. It's making sure it takes account of your current and future requirements and really achieves your personal objectives. Before we move on to the presentations, I thought it would be helpful to provide a bit of context. So the theme for today is wealth management with a particular focus on inheritance tax planning. So why is that important and relevant to us today? According to the government's own figures, in 2018-19, which is the last year that there's published data, HMRC collected £4.6 billion in inheritance tax on death. Other situations where inheritance tax is payable, but on death, £4.6 billion that the revenue collected. The average amount of tax that was payable by estates that paid inheritance tax was just over £200,000. So we're talking significant numbers where people are subject to inheritance tax. As you're probably aware, each individual has an inheritance tax-free amount, and that's currently £325,000. That's been the same since April 2009, so 13 years, and according to the current government at least, that's going to stay the same until April 2026. By way of comparison, if you'd invested £325,000 into a FTSE 100 tracker portfolio in April 2009, it could today be worth approximately £585,000. So an increase of about 80% in a time when that inheritance tax allowance hasn't moved at all. So ignoring any other assets, this would result in an additional inheritance tax liability of just over £100,000, when in 2009 perhaps it would have been tax-free. Or perhaps you bought a house in Horsham for £325,000 in April 2009. According to the Nationwide House Price Index, it could now be worth approximately £650,000, so doubling in that period. So again, the extra inheritance tax on that could be nearly £130,000. So this is fiscal drag. This is tax allowances not keeping up with the increase in asset values. And it means that more estates are being subject to inheritance tax, and those that are subject to inheritance tax are paying significantly more than would previously have been the case. This is partly offset by something called the residence nil rate ban that we'll hear about later, but that can only be used against certain assets and not everyone qualifies. As well as more estates being subject to inheritance tax, we have the potential for more changes to inheritance tax coming in when we get a new Chancellor at the beginning of September. And I don't have a crystal ball or a hotline to the new Chancellor, but changes to inheritance tax could include extending the time before death that gifts must be made to be exempt from inheritance tax. At the moment it's 7 years. Perhaps that could be changed from 7 to 10 years and making it a much longer period that you've got to survive for gifts to be exempt from tax. We'll hear later about something called business property relief. That's a hugely valuable relief. We think it's quite likely that the rules for business property relief might be changed to align it with something called business asset disposal relief and make it more difficult to qualify for this exemption from inheritance tax. The other thing we've seen in the press and was looked at by the government before was aligning capital gains tax rates with income tax rates. And that could make it more expensive to transfer assets to the next generation. I think it's important to highlight that it's really unlikely that any changes made would be retrospective. So if you can make changes, transfers or implement planning today or under today's rules, it could mean that you're not affected by those future tax changes. Also, I'm sure you must be aware that it's been a challenging time for the stock market since the beginning of the year. Those depressed equity values could make this a good time to consider transferring assets, reducing any capital gains tax that's payable, and ensuring any future increases in value are outside of your estate. Joe will talk a lot about inheritance tax planning later on. I think with careful planning, your inheritance tax exposure can be potentially significantly reduced and ensure that your chosen beneficiaries receive significantly more post-tax value. We hope that after today's session, you'll have a better understanding of how to fund your retirement, the importance of wills and powers of attorney, how trusts can be used, and some of the strategies available to help reduce your inheritance tax exposure. Before we move on to these topics, I'm going to hand over to Rupert, who's going to talk to us about art and antiques and chattels.